Let me now bring on board Mahesh Patil, Co-Chief Investment Officer with Birla Sun Life Mutual Funds. Mahesh, good morning. Thank you for joining us. Mahesh, the quarter gone by, things have been rather nasty for Indian markets. Despite strong global liquidity, benchmark indices are under intense pressure. How would you characterize and map the market environment?
Well, as you rightly said, I mean, the global environment last quarter was pretty benign, actually. Global markets did much better than the domestic markets. I think domestically we had our own set of issues over here. Initial after the hype and expectations of reforms being carried forward, and a lot of expectations in terms of speedy recovery of some of the projects which have been stalled. We haven't seen much action over there from the government. And that's why, and again, high current account deficit is something which has been weighing down on the market because of that. Potential pressure on the rupee is something which is a concern, okay, from foreign investors also. And rate cuts also, to the extent one was expecting, the speedier and the magnitude of cuts which one was expecting, I think that's also likely to be slower. So in the backdrop of this, we have seen the markets slightly underperforming some of the global markets. Having said that, I think the downside again from these levels, because I think most of the negatives are already priced in. So one doesn't see too much downside, but I think the upside also is likely to be capped for the short term.
Mahesh, so what is it that you're picking up from some of the global mood checks in terms of how the FIIs are going to approach this month? Because we'll have earnings as well to deal with this month.
Well, I think difficult to predict what the FIIs will do. I think by and large the mood is that the global risk-on environment continues. Given that backdrop, you will see flows coming into our markets. Most of it typically are top-down flows, not really India-specific flows. There's nothing really to suggest that money is moving into India specifically because domestic reasons. And as you rightly said, I think focus this month would be more stock-specific, depending on the earnings, how they really pan out. I mean, some of the IT names would be the first on the counter where we will look into it. By and large, again, this quarter also looking at for the domestic companies, we have seen the slowdown continued. We have seen the recent auto numbers also coming in pretty weak. So the numbers are not going to be that great, but my sense is that a lot of it should have been priced in by this point in time.
So Mahesh, what is your portfolio strategy at the current juncture? Are you hiding in expensive quality names, or you are now prepared to really go down the ladder?
Well, I think this kind of a market where we're looking at a range-bound kind of a market, and mind you, the market is very polarized. As you rightly said, some of these sectors where there is good visibility, sustainability of earnings, the valuations at the extreme end. In fact, the divergence between some of these sectors, which are so-called defensives, and the other cyclical sectors, or where there are some issues, is an all-time high. So in this kind of an environment, I think we would need to be much more balanced in our portfolio, not to be too much biased towards some of the defensive stocks, and neither too underweight in some of these cyclicals, because things can really turn around pretty sharply. So I think a balanced approach is what we are doing in our portfolios across sectors. And focusing more on company-specific, I think this is a time to again come back on company-specific, stock-specific, bottom-up is what we'll be looking at. And looking at companies where there is some kind of a stability, some kind of predictability, and our expectations for the markets are pretty modest. So even if a stock is likely to give us around 15-20% kind of a return, with decent amount of stability, we're happy to look at those companies rather than really looking at some of the high beta names.
Mahesh, you were just talking about the negative sentiment surrounding the auto space. Is auto as a basket a complete avoid, or do you think there are still pockets of opportunities like an M&M which continues to actually deliver growth?
Well, autos, I think the slowdown, what we have seen was to some extent expected, and we have seen the discretionary spending getting impacted. I mean, discretionary sectors getting impacted in the last 2 or 3 months. And my sense is that that will continue for some time. But by and large, we have seen auto now sector being under pressure for almost a year now. And this year we have clocked almost negative growth rate. As we move forward, I think the base effect will start to kick in. And as interest rates come down, I think that at the margin should act positive. So I think looking at the valuations and the correction what we have seen in the auto sector, stocks in general, I think we would not be that negative. Yeah, though I think there is some near-term pain for next 3 to 6 months. You will see the numbers being pretty weak. But I think that should bottom out, and we have seen typically in a year, 1 year negative. I think next year we have seen the auto sector really bouncing back. At least history has suggested that. If that's an indication, then I think the second half of FY14, I think one should see a revival, and if rates come down, I think that should add to that. So I think given the current valuations, it could be a good time to look at some of the auto stocks in the next 3 to 6 months time frame.
Mahesh, so based on underlying growth assumption, in next 12 months, in next 24 months, which sectors to your mind could go through a process of derating, and which sectors to your mind could go through a process of re-rating? I mean, the real money is made when P multiples are derated or re-rated.
Well, looking at the state of the economy where we are at this point in time, and assuming that we are somewhere near the bottom, and we could see a mild recovery at the end as we move forward in this fiscal year. So given that, and the sectors which have typically bombed out, so typically the cyclical sectors or domestic cyclicals is where I think one can see one gets more visibility in the recovery going forward. I think these sectors are likely candidates for a re-rating, because the valuations there are at almost like 1 standard deviation or 1.5 standard deviations below the long-term average. So that's where I think one should likely to see a re-rating. And sectors like defensive, FMCG, which have been at, as I said, again, they're at the upper end of the valuation spectrum, almost 1.5, 2 times above the long-term average. In those sectors, as we see some slowdown, actually we are seeing now even slowdown in the so-called consumer staples. In fact, last quarter was indication of that, where we saw volume growth slowing down. So given that the growth is slowing down, I think, and the premium valuations, FMCG is a sector where you could see some derating going forward. While the stocks prices might not correct in absolute terms, I think there could be a time correction in some of these stocks.
What about banks and financials though, Mahesh? When do we see a turnaround, and do you sense that perhaps the second half of this year could actually turn out a bit better?
Well, banking and financials, yeah, it's still, I mean, we have seen some pressure points there in terms of asset quality. We were expecting things to actually stabilize in this quarter, but we have seen some fresh round of pain in some of the sectors, and as the economics recovery, as I said earlier, is not as per the expectations. So given that, I think there could be some more pain there on the asset quality, but I think it will be more bank specific. I won't generalize that to the whole sector. So I think stock picking in the banking sector and companies, okay, where asset quality is pretty stable, I think that should still provide you good results in the sector. And we see now the interest rates coming down. The wholesale rates now should start to ease off as liquidity conditions are likely to improve post-March. So that should help some of the wholesale funded banks in terms of reducing their borrowing cost. So that should help some of these banks to expand their margins going forward. So by and large, I think the sector should do reasonably well, but it will be more, again, company specific.
Mahesh, at a time when global growth dynamics are quite favorable and genuine global demand seems to be making a comeback, do you think it's a matter of time global cyclicals will also revive?
Yeah, to some extent, but I think if you look at the global cyclicals, I mean, from India's standpoint, there are two sectors which really stand out. One is the commodity sector, and the second one is the IT space. So on the commodities, I don't think the recovery what we are seeing in the global side is not going to be that dramatic, okay, to really make a big turnaround for the commodities or increase in commodity prices, because China is one of the major factor in that, and one doesn't see the economy really coming back that strongly. So we're not so bullish on commodities in terms of price action over there. On the IT space, however, things can be looking a bit better this year, this calendar year. Already talking to some of the large IT firms, we get a sense that this year should be better than what we saw last year. Nothing dramatic, but the margin things should be better.
Tactically, do you think now it's time to align with mid-cap stocks? Because mid-cap stocks have fallen, they've really fallen hard. The mid-cap index this year is down by about 10% versus the benchmark index Nifty, which is down by about 3.5%. Yeah,
I think again looking at mid caps again has to be very, very company specific and stock specific, Even in a bad market last year, there were a few mid-cap companies which did exceedingly well and outperformed the market. So it's all about stock picking in the mid-cap space. But to generalize, I would say that, yeah, I mean, we have seen a deeper correction in the mid-cap space. I mean, the mid-cap index is now below what it was in September last year. And valuations are starting to look a bit attractive. And as we see, if we see a recovery in the broader economy and things stabilizing, then clearly the mid-cap should hold on. And if you take a slightly longer term view, and expectations that rates will come down, which should typically, as liquidity conditions ease, mid-caps tend to benefit from that much more than the large cap, because they get also badly affected when liquidity is tight. So in that backdrop, I would say it's a good time to start looking at cherry-picking mid-caps, building up on your portfolio from a slightly medium to long-term perspective. But again, management quality is very critical, so backing the right management and the right company is very important in the mid-cap space.
Mahesh, the one sector which has really helped the market wade through has been IT, and soon we're going to be approaching earnings, and they will begin with IT names as well. Do you think there is a possibility of a negative surprise, or is it going to be all green for the sector?
Well, IT sector this quarter should not be that great. I think it should, whatever expectations are there, I think in terms of recovery in the global, I think that should benefit in FY14. And this quarter is typically sequentially a weaker quarter. So having said that, I think we are expecting, broadly in the top line IT companies, the sequential revenue growth should be anywhere between 1 to 3% or so. There could be some pressure on margins, and this quarter one doesn't expect any currency gains. Actually, at the margin, the cross currency, this thing, it should be slightly negative. So I think expectations are not that high in this quarter. So I think by and large the company should be okay. We don't expect any big disappointments or any positive surprises in this quarter from the IT sector.
Mahesh, final idea, any out-of-box ideas, any themes or businesses where you are allocating disproportionate amount of money and where you are reasonably confident that the risk-reward ratio is favorable?
Well, as I said, clearly, if we expect some kind of, at least we have a lot of hope from the government that they would look at some of these sectors which have been stressed out, whether it's in the power sector or some of the metals and mining sector where a lot of projects have been stalled. So that could be a dark horse really sector, because here a lot of companies are now quoting at valuations, even the metal space, at 3 years low really. The company is quoting significantly below their book value. So if there is any improvement, one expects that government will start looking at favorably at some of these projects and clearing them. I think then there could be a significant upside in some of these sectors.
Mahesh, really good chatting with you. Appreciate you taking the time out and joining us.